UK government borrowing rates are said to be running at 5.6% at present, which is one of the highest rates for decades. It sounds terrifying, but it isn't, because this is just market noise. The only reason why these rates are so high is because people are selling government bonds to put the money into the record high level of the FTSE 100. And when that crashes, all the money in the FTSE 100 is going to flee back into bonds and the rate will crash again. Let me explain. If a government issues a bond for £100 and pays 4% interest on it at the time of issue, then that is fixed for the whole life of the bond. It never varies. But at the moment, people are selling their bonds, and suppose that £100 bond is selling for £80 at present, then the 4% interest paid on it is now worth 5% in comparison to the current £80 price. But suppose instead that the price goes up to £120, which it might well do if the stock markets crash, because that's what happened in 2000 to 2002, when we last had a serious stock market crash, and in that case, the interest rate would fall to 3.3%. Yields move with the price of government bonds. The risk of lending to the government does not change. All of the risk we've got at present is precisely because money is chasing stocks. There is an AI bubble in the stock market, and when they crash, as the Financial Times says they're going to, as the New York Times says they're going to, and as I said before either of them got around to doing so, then we are going to see prices in the stock market fall and the price of bonds rise, and so the cost of UK government borrowing will fall again, and as a result, Rachel Reeves' borrowing costs will be solved. Don't listen to the hype, in other words. There is no crisis in the cost of government borrowing in the UK.